This is Leaders of B2B Alternative Financing, powered by Capital Express. Our guest today is Paul Myers, Chief Executive Officer and Chairman at Advocate Capital. Now here's Paul with your host, Mark Anundson.
Paul, welcome to the podcast.
Well, thanks for having me. I appreciate it, Mark. I look forward to it.
You're with Advocate Capital.
That is correct.
Give me the elevator pitch.
Yeah, we are a specialty finance, commercial finance firm. We're a wholly owned subsidiary now of Pinnacle Bank. We were founded in 1999, and Pinnacle Bank here in Nashville bought controlling interest, or 100% of the stock, in July of 2019. We basically provide annually renewable working capital lines of credit to contingent fee law firms around the country. And the contingent fee law firms, their primary need for working capital are the case expenses. They front all the case expenses for all of their cases. And so our funds are primarily used to provide capital to help cover all of those case expenses, which can be pretty high numbers. But we do it in such a way, we have a back office proprietary software platform called AdvoTrack, which, if you strip it away, basically it takes all of those cases, and all of the fundings on each of those cases are treated like a little bitty loan. So it might look like a $300,000 or $400,000 or $500,000 line of credit, but what it really is 100 little $4,000 or $5,000 loans. And what that does for our clients is it allows them to recoup the fees and interest that they pay us, just as if it were another case expense in the case. So for the cases that they win, the cost of capital is zero.
The cases you win cost you zero. To me, that's the selling point, right?
Oh, yeah.
But I want to ask you more about that. But before
sure.
I do that, my biggest question is, how did you even think to get into this kind of a business?
I wish I had come up with the idea and founded this thing. But back in 1999, a really smart guy by the name of Ben Goff founded the company. And he just bootstrapped it. He came from a finance background. He worked at the time for Primus, which is part of Ford Motor Credit. Mm-hmm. But his father is a plaintiff law firm in Dallas. So he kind of saw that plaintiff law industry was severely underbanked and undercapitalized. And most of the folks who are in the industry were using their own after-tax cash to fund all these case expenses. And he kind of figured out a way to build a better mousetrap. He quit his job at Primus, started doing this full time. I ended up meeting him through a lawyer friend of mine in 1999 and was just really kind of intrigued by the whole concept. And I guess in 2000, I helped him find an investor group to come in and further capitalize the business. And he brought me on as consulting chief financial officer at the time. And I wrote the credit policy manual. I wrote all the operations manuals. I put their accounting systems together. I helped build, in the very early days, my software engineering credentials are slim, but did help build the beginnings of what now is AdvoTrack. And so I started as a consultant. In 2001, we were able to attract third-party senior debt capital, which you may be aware, in any kind of commercial finance business, leverage is key. You have to be able to leverage your balance sheet. And so at that point, I came on full-time in roughly, I think I started consulting in late 2000 and came on full-time in June or July of 2001. So I've been here about 25 years. Was the chief operating officer, credit, finance, all of that kind of stuff until I guess about 5 years ago when the CEO, one of our investors, retired after the Pinnacle merger, and I became CEO and chairman at that point. So I wish that I had been the one that figured it out, but Ben Goff, who was the founder, ended up leaving the firm in 2003. As happens sometimes with folks who are really, really good at taking risk and thinking up really cool ideas, operations and execution for an investor team was not what he wanted to do. And so he resigned and sold his shares back to our investment group.
Wow. Thinking about the business, I was kind of fascinated a little bit because when I first looked at your website, I thought maybe each individual lawyer would say, hey, I have this case. I think I'm going to win $10,000.
Yep.
But you're basically underwriting a law firm, and
Exactly.
you set your credit limit based on the size of the law firm, how many lawyers, or just
It's
how does that
based
work?
primarily on a couple of financial ratios. One is what we call revenue to line, which is basically how much fee income are you generally generating each year. We underwrite really a lot like a bank would. We don't look at the group of cases or an individual case and try to figure out if they're going to win it. What we do is we look at their historical ability to generate fee income, build net worth, and grow a law firm. And so we look at their revenues that they bring in, all of their fee income, and we normally look to see a 3-to-1 ratio. In other words, if a law firm is doing $1 million a year in fee income on a historical basis, we'd probably be looking at a $300,000 to $350,000 max line. But we also look at the overall net worth of the firm and the partners, and we look to have that be at least 1-to-1. In other words, for that $350,000 line, we'd want to see at least $350,000 in combined net worth. Those are our two primary drivers from an underwriting perspective.
Interesting. And one of the things that fascinated me was when you win the case, you don't pay any of the fees.
Right.
Could you sell this without that feature? Or was that always a part of the plan?
It's always a part of the plan. When you get down to it, if you're just doing lines of credit, I mean, it's like selling potatoes. I mean, it's cash. How do you really differentiate? Of course, we pride ourselves on having great service and taking fabulous care of our clients and trying to be extremely responsive and accurate and timely and efficient and all of those kind of things. But that only goes so far. And anybody can sell you cash. Every bank in the country is trying to get you working capital. Now, this industry has been historically underbanked because most traditional commercial banks don't recognize the value in contingent fee receivables. They like law firms, like the big giant corporate firms that perform a lot of work, they bill, they get paid in 30 days. We'll lend you 70% of your accounts receivable that are less than 90 days old. Most banks have a hard time really wrapping their head around the contingent fee receivable and how that works from a collateral perspective. We long ago figured out that, it's not as definitive, if you will, as traditional accounts receivable, but it's very collectible. And so we figured out ways to do that and get comfortable with that risk. It's one of the reasons Pinnacle Bank bought us is they love the model, they love the yield, they loved everything about it, but they're like, we can't figure this out. And you seem to have figured it out. Why try to build this thing when we'll just buy you? And so that's how that came about. But traditionally, they have been an underbanked group. But again, there are firms out there that will provide capital for case expense funding. But why do you want to go pay 8, 10, 12, 15, 20% and never get that interest back? If you can do it in such a way where, you're still going to pay a decent yield, but if you're successful in the case, which on average, they get their expenses back on 95% of the lawsuits they bring. If you're going to get 95% of your interest back, your net cost is less than 1%.
Yeah. I mean, that seems like too good of a deal to be. Why would you ever turn that down? If I owned a law firm, I'd like, let's cash flow our business this way. Traditional factoring is the business I've been in, and accounts receivable financing. I think what you're doing is closer to like PO financing in our world, right? You're doing it before it's actually an invoice. And in the almost 30 years I've been in this business, we've had a handful of small law firms do this, but it's not till after they create the invoice. At that point, the law firm doesn't need the capital as much as they do while they're having expenses for the case. So I think it's a genius idea. What happens if somebody defaults? Have you had defaults?
Oh, gosh.
And do you have to sue lawyers? I mean, that sounds like a nightmare. I got to sue a law firm.
Over time, we probably originated over 1,000 relationships. Right now, we have 580 active law firm borrowers in 48 states and DC. But we probably originated over 1,000 deals. They tend to renew every year. Most of our clients have been with us for 5, 10, 15. Our first client we got in October of 99 is still a client. But when they go sideways, which if you do enough business, even if you're following credit policy, something's going to go sideways. It just happens. If we had no risk, we had no default, then we'd be lending at Treasury yields, and you don't make a lot of money doing that. So there is some risk there. The vast majority of the time, I can't even tell you. Anecdotally, probably we've had 100 workouts of some sort, and I think we've had to file suit 7 or 8 times. It doesn't happen a lot. Most of the time, as long as the law firm stays communicative and doesn't stick their head in the sand and say this is going to go away, because it's not. Most of the time, if they remain communicative, we can stay in the game with them. We'll have to take it to non-accrual status, and we'll have to charge a portion off and all of that kind of stuff. But we continue to work with them. And a lot of times what we've had is this is not like a manufacturing operation where they're just like grinding stuff. They get a big case and they hit it, and you can get a windfall of repayment. So our goal is always to try to keep them operating and try to keep them talking and sharing information with us. It's the best thing for them, and it's the best thing for us. And so, there are defaults. There are, times when you file a lawsuit. I had as a matter of fact, I had one that we did have a lawsuit, and last week we had a mediation, court-ordered mediation that actually mediated and settled. So we're going to walk away with a nice recovery. This guy's going to be able to get rid of the debt, but everybody's going to end up, I won't say happy, but happier than they could have been had we had litigate the whole thing. So it happens, but it's rare. I think I can only think of one time where we actually sued somebody and they did not engage other counsel and they represented themselves. Most of these folks realize that, hey, if I'm in a dispute with my lender about repayment, this is not a contingent fee. This is not a plaintiff. It's not a personal injury thing. This is a contract issue and an Article 9 and UCC issue. I need to get somebody who knows what they're doing. I remember because I had one client down in Dallas years ago, and I was saying, did you read the contract? There are things in there. And he goes, Paul, that's like going to a podiatrist for a blemish on your face. He goes, no, I didn't read I'm not a contracts attorney. I'm like, well, shame on you for not having somebody read it. So these guys they realize when they're out of their depth. And so they're going to contract with another attorney, and we're going to have our legal counsel. And then it becomes more of a traditional commercial lending dispute and discussion.
What are some of the most rewarding things that you've seen happen in your career here?
I'll tell you one thing. I do a 30, 45 minute little presentation for new team members when they come on board. And one of the things we talk about is the Seventh Amendment, which, in case you or the listeners don't know, it's the right to a jury trial. And it's not, in America, it's not just any jury. It's a jury of your peers, meaning that you don't have to own property. You don't have to have a certain amount of wealth. You don't have to have a certain amount of education. If you're 18 years old and a citizen, you can be on that jury. So it creates kind of a community-based governance for civil and criminal justice issues. And what the contingent fee attorneys do is basically give the keys to the courtroom to anybody who needs access to the civil justice system. Because the vast majority of the people, if you walk out the door and get run over by a drunk delivery driver, you've been harmed, you have a right to receive compensation. But most people can't afford to go pay $800-900 an hour to an attorney. These contingent fee attorneys give 99% of Americans access to the civil justice system. I love that. I'll give you an example. We had a client in Marietta, Georgia. I don't know if you remember, about 5 or 10 years ago, there were this whole NHTSA, National Highway Transportation Safety, something or other, recall of a whole line of General Motors cars because their ignition would turn off with no warning. So, you're going down the interstate 75 miles an hour, your ignition turns off. Well, that's one thing, but now your power brakes and your power steering are gone. Mm-hmm. And so basically you're a 75 mile an hour death rocket. And what happened is our client, this happened in North Georgia, this car, the GM thing, the lady just veered across the median of the interstate, hit another lady, killed her and her child. Mm. And so, of course, the lady who died and the child who died, their husband and father had a very serious claim. So my client represented that individual, the victim in that crash, and got a very nice settlement from the insurance company. And it was confidential, but he started really thinking about what happened there. The woman did not have anything in her system. There was no evidence that she had fallen asleep. It was just out of the blue, this thing happened, and she had claimed that everything locked up. And, at the end of the day, it didn't matter from that standpoint. But what he started thinking was something's not right. And so he called opposing counsel after the settlement was done and paid and said, hey, look, I know this is confidential, but I think something's up here. And so they started digging, and they ended up suing General Motors, and it ended up being a class action. So there's enough other people that this had happened to where they got, hundreds and hundreds of people who had said, this thing happened to me. It wrecked my car. I hurt somebody. I hurt myself or something. And during discovery, he found out that not only was General Motors aware of this issue and chose not to recall, they had done an actuarial study internally that basically what they were looking to find out is it more advantageous to us from a profitability standpoint to recall, I can't remember, hundreds of thousands of automobiles voluntarily, or just defend the ensuing lawsuits one at a time. And when that came out, it was done. I think our client got $200 million for the plaintiffs. Wow. And NHTSA forced a recall. So GM got hammered twice. So my point there is, yeah, these guys and ladies go out and they get justice for their clients and they get financial compensation, but a corporation is nothing more than an entity to generate profit. And that's not a bad thing. But all too often, corporations make decisions in order to generate that profit that are contra to the health and safety of individuals. And because the government can't regulate everything, the contingent fee attorneys, the plaintiff bar, really almost serve as that check. Because the only way to punish a corporation is to hit them in the pocketbook. You can't send a corporation to jail, but you can make them hurt. And so that aspect of what they do every day, I've always been very proud to be a part of. And just beyond that, I've never been in a client's conference room where there's not a box of tissues sitting on the thing, because they talk to people every single day who have recently had probably the worst day in their life, and they figure out a way to get them justice and to try to make them as whole as they can. And I'm proud to be a part of that.
That's amazing. So today we've had Paul Myers with Advocate Capital here. Paul, in closing, is there anything we didn't talk about that you want to put out there?
I think that I and the folks who are on my team, we're one of the few folks who do this, and probably the only one who does it in the way that we do it. I mentioned before that there are other firms out there who will lend plaintiff attorneys money, but the capital is only part of it. The service level that we provide, the software, and the access to real-time tracking of your cases. We have about 95,000 cases right now under management. And again, that's 95,000 people who have sometime in the last year or two have had the worst day of their life. And so we're proud to be a part of that. We're proud to do it in a profitable way, but we really do, I think, have that proverbial win-win where, hey, we win because we get paid good yields and we don't take inordinate risk, and we make a good profit for us and for our shareholders. But at the same time, our clients get the benefit of access to capital at less than 1% net cost. And their clients get the benefit because our clients have access to capital, meaning they can hire the best specialty witnesses, best doctors, best whatever it is, so that they can go toe-to-toe with the insurance companies and the larger corporations. So I'm proud that Advocate has built that niche and serves that purpose.
Paul, we thank you for your time today, and we look forward to talking to you in the future.
This is Leaders of B2B Alternative Financing, powered by Capital Express.